While being slightly fast-paced, BigBear.ai Holdings Inc. (BBai) closed its last trading session on Friday, October 10, 2025, at $7.22 a share, representing a significant negative 3.60% drop from its previous close, with an after-hours price only marginally higher at $7.23. The common expectation among retail online investment communities and casual traders watching this stock is that this is simply another violent meme stock-like pullback after a recent parabolic move, a necessary cooling-off period before the next leg up, perhaps fueled by the general enthusiasm for AI companies like Nvidia stock and even Tesla stock. However, the reality of the situation, the deep technical and fundamental truth lurking beneath the surface, is far more complex and involves a highly unusual pattern of institutional selling pressure immediately following major defense contract news, a stark divergence from what we'd expect in a strong growth narrative. Specifically, we've seen a staggering trading volume of 236.91 million shares on the day of the drop, dramatically exceeding the average, indicating large-scale distribution rather than retail profit-taking. This heavy volume on a down day, where the price traded in a massive range from $7.20 to $8.80, strongly suggests that sophisticated players are locking in gains or reducing exposure, despite what appears to be a strong fundamental tailwind of new government work. This immediately forces us to ask, do they know something the market is missing, or are they simply wary of the company's precarious financial health in the face of continued dilution? This tension between the market's high expectation for a government AI darling and the cold reality of its financial mechanics is precisely what makes BBai stock one of the most compelling and dangerous speculative plays in the market right now. The common ground for BigBear.ai investors rests on the narrative of an AI pure play deeply integrated with the U.S. national security and defense apparatus, the Palantir analog, if you will, but with a smaller market capitalization, currently sitting at around $2.68 billion. The belief is simple. AI is the future, and government spending on AI is recession-proof, providing a massive, predictable revenue stream. This belief was bolstered recently by announcements like the enhancement of maritime domain awareness for the U.S. Navy Fourth Fleet and the accelerated U.S. arrivals at Nashville International Airport using their biometrics technology, which are concrete, high-impact deployments that validate the technology. The contrarian view, the reality we must confront, is that BigBear.ai is still fundamentally an early-stage company grappling with scale and profitability, exemplified by its earnings per share sitting at a negative $1.59 on a trailing 12-month basis. Furthermore, while the news flow is positive, the capital structure is showing signs of strain. The August 2025 earnings report showed a significant revenue miss against analyst estimates, with a negative 19.98% surprise, confirming that translating massive long-term government contracts into predictable quarterly revenue remains a major challenge. When you are looking to invest online through platforms like SoFi Invest or Robinhood, where the barrier to entry for self-investing is low, it's easy to get caught up in the headlines. But professional investors operating through institutional platforms like Interactive Brokers are keenly focused on the fundamentals, which show a company with negative cash flow from operations and a history of significant shareholder dilution. For those of you engaging in online investing, particularly in volatile small-cap tech, understanding this delicate balance is critical. The technical chart confirms this psychological struggle. The recent surge, driven by the AI hype cycle and the perception of massive contracts, ran directly into a wall of resistance near the $8.80 level, which served as the high for the recent trading day, suggesting a psychological ceiling that market makers were unwilling to let the stock sustainably breach without more fundamental improvements. The short-term movement reflects a classic speculative bubble deflating slightly, with the price now sitting directly on a critical support level around the $7.20 mark, which, if broken, could precipitate a deeper slide. The technical indicators are mixed, with some longer-term moving averages, like the 200-day, still indicating a bullish trend from the massive run-up earlier this year, but shorter-term signals, like the daily RSI now hovering around the neutral to sell territory, suggests that the immediate momentum has evaporated. The sheer volatility, reflected by a beta of 3.18, means that for every 1% move in the overall market, BBai stock theoretically moves over 3%, making it a high-octane trade and a potential landmine for passive investors, including those using something like a Schwab Intelligent portfolio that might not be designed for this level of extreme risk. A closer look at the company's core business reveals why the narrative is so compelling, yet the execution is so choppy. BigBear.ai is not just an AI consultancy. It is a decision intelligence platform provider whose core product is designed to fuse masses of disparate data, from military intelligence feeds to logistics chains and biometrics, and use advanced machine learning models to provide predictive, actionable insights. This predictive visualization capability is a genuine differentiator in the defense and intelligence sectors. The company's recent $380 million order backlog, which grew substantially over the last quarter, is a testament to the demand for this technology. Key contracts include the long-term work with the U.S. Army on the Global Force Information Management Objective Environment project, which alone is worth an estimated $165 million over 5 years. This backlog is the foundation of the bullish case, representing future revenue visibility that many unprofitable tech companies lack. However, the operational side of the business, specifically the conversion rate of this backlog into realized revenue, is where the gap between expectation and reality widens. The Q2 2025 revenue of $32.47 million was markedly lower than expected, a clear sign of the lumpy nature of government contracting, where the timing of project starts and payment milestones can throw quarterly financials into disarray. While the company holds a comparatively healthy cash reserve, the pressure to meet the high growth expectations set by the AI sector hype, which has propelled giants like Apple stock and Microsoft to record valuations, is immense. This pressure is compounded by intense competition from much larger, more established players like Palantir Technologies, which also focuses heavily on government and defense work. Investors must weigh the potential for BigBear.ai to become a multi-billion-dollar enterprise against the reality of its short-term losses and the risk of dilution, especially given the previous follow-on equity offerings. The volatility is not just a feature of its youth, but a direct consequence of this financial tightrope walk, and any unexpected delay in a government contract payment or a revenue miss can trigger a sharp sell-off, as we've seen recently. The market reaction to the recent news, particularly the partnership with the U.S. Navy for maritime domain awareness at Unitas 2025, was initially a surge, but the subsequent decay in price suggests institutional memory is longer than retail trader attention spans. They remember the missed earnings. They see the negative EBITDA. They look past the press release to the protracted path to profitability that remains uncertain. This pattern is crucial for anyone managing their own individual brokerage account or engaging with Fidelity investments. You have to look at whether the contracts are simply maintaining the status quo or if they are truly high-margin commercial contracts that can diversify the revenue away from the traditional lower-margin government work. BigBear.ai's move into commercial biometrics at airports is a strategic step towards this diversification, leveraging its government-grade security expertise in the civilian sector. Yet for now, the bulk of the company's value proposition remains tied to the national security budget, which, while large, comes with its own set of procurement, budgeting, and political risks. The institutional holdings in the stock have been increasing significantly among major asset managers like Vanguard Group Inc. and BlackRock Inc., a positive signal that long-term investors are establishing positions, potentially offsetting the short-term trading of hedge funds. This institutional interest provides a necessary floor for the stock, but it does not remove the speculative froth. It simply indicates that smart money believes in the long-term vision of a specialized AI defense contractor, not necessarily the current valuation or the next few quarters of financial results. The risk-adjusted return profile for BBai, given its high beta and consistent unprofitability, is certainly not suited for a passive Fidelity ETF's approach, nor would it be a core holding in a cautious Fidelity wealth management plan. It is a high-conviction, high-risk trade. Looking ahead, the future of BBai hinges on three critical catalysts. First, the successful conversion of its record $380 million backlog into realized high-margin revenue over the coming quarters. Any positive surprise in revenue-to-backlog conversion will instantly challenge the prevailing skeptical reality and propel the stock higher. Second, the scaling of commercial products like the biometric solution and Shipyard AI, which targets the massive shipbuilding logistics market. True enterprise-grade recurring commercial revenue will dramatically improve the profitability timeline and reduce the perceived risk of customer concentration on government spending. Third, the potential for a new, massive, multi-year government contract win, perhaps tied to new initiatives in cybersecurity or physical AI, the company's next frontier. This is